Joining us now is Hertz's new CEO, Stephen Scherr, and Polestar CEO, Thomas Ingenlath. Good to see you guys both here. Congrats on this tie-up. Stephen, let me start with you here. Why'd you choose Polestar?
Well, we chose Polestar because they are manufacturing a really impressive automobile that we think fits sort of square within the growing electric vehicle component of our fleet. And we're looking to take on any and all OEMs that are producing quality vehicles, and this car that's being produced by Polestar is exactly where we want to be. It's an impressive automobile.
Thomas, it's Julie here. When can I rent a Polestar through Hertz? And is this also a tool for you to get these vehicles into consumers' hands, for lack of a better word, and get them more familiar with the product?
Yeah, hi, good morning, Julie. You should be able to find a Polestar as early as, middle of this year, definitely. Yes. Here in the US, as well in some European countries, just in case you're traveling this summer. And it's exactly what you say. It's two things. On one hand, generally consumers being able to experience an electric drive, not in a short test drive, but really over the period of 2-3 days. And on the other hand as well, for a brand as Polestar, very young to the market, to actually get visibility in the eye of the customers.
Stephen, so in November, we caught up with Mark Fields, at the time the interim CEO of Hertz, and we were talking about how many orders he placed for Tesla vehicles. Now you have Polestar coming on board. How does this change how you roll out charging stations? Does it change how you roll out mobile app updates, just given the two different experiences?
Well, we've long contemplated it as a company that we would grow the component of our fleet to about 20%, over the next year or so, and then grow from there. Obviously, simultaneously, we are giving great thought and executing on the development of a charging network. So far, we're at about 1,000 charging stations across various markets. We think we have a sufficient number of stations to reach 80+% utilization. But that's not going to stop there. As the fleet grows, the charging network will grow as well. And I have every expectation that this will become part and parcel of a much broader charging network initiative, that will cut across the United States, no doubt the world, as electric vehicles become just more prolific, in their development. But the two go hand in hand, and I think we're at a very, very substantial point to be able to sustain the growth in the EV component of the fleet.
Stephen, do you think we're at that point now where EV makers like a Polestar and of course Tesla are just churning out so many electric vehicles that your entire rental fleet will be electric within the next 5 years?
Well, I think that's a tall order. I don't know that it's going to be that profound. We run a fleet now of about 500,000 vehicles. We'll get to 20%. We'll grow it from there. Obviously, consistent with the question you asked before, the charging networks need to grow, not just of our own, but more broadly. But our ambition is to have the largest electric vehicle fleet in North America, expanding around the world. We're on the way to doing that now with this announcement of Polestar, obviously what we're doing and will be doing with other OEMs as well.
Thomas, talk to me about production for Polestar. I know that you all have a production goal of 290,000 vehicles a year by 2025. Does this deal mean that you're going to be boosting that goal anymore, or is it just that a chunk of those vehicles is going to go to this Hertz deal?
This deal with Hertz indeed is part of our 290,000 ambition for 25. So here we, of course, confirm and are very confident about this quite substantial growth. But this is a tipping point of the industry. We have not only in the private consumer field a really strong demand for electric vehicles. We see this especially now in the first 3 months of 22, but as well in in the rental business. We have as well together, of course, the aim to go into shared mobility, into the fleet of companies that are striving for CO2 reduction in their footprint. So all in all, indeed, there will be a very strong momentum. And I think that is a very clear symbol for this, what's happening in the industry.
I mean, the interesting aspect of this, combined with other electric vehicles that we'll buy, is that it really expands the scope of business for Hertz. Obviously, we will rent these vehicles out to individuals, but equally, we will rent them out to fleet participants, the likes of Uber. And then finally, as Thomas was referencing, we have corporate customers who have their own CO2 and ESG ambitions, and where they can put their employees into electric vehicles, they are, in the satisfaction of that objective. And so this is really an expansion, if you will, of the business lines that Hertz can be in, with the benefit of the Polestar product.
Thomas, I also wanted to ask you about the status of your de-SPACing, so to speak. That is Polestar going public through a SPAC transaction. Can you tell us where you stand on that, and if some of the new SEC rules on SPACs are going to delay that closure to any extent?
Well, we are going as described through the regulatories and expect our de-SPAC within the Q2 happening.
Stephen, I want to see if I can quickly channel your former life at Goldman Sachs and your new life over at Hertz. Interest rates are on the rise. How much more difficult does that make turning a company around like Hertz?
Well, I think, Hertz is in a formidable position, not just in its competitive standing with EVs and other vehicles and a broader product offering, but I think its financial footings are in exceptionally good position. We have got ample liquidity. The cash flow of the organization continues to be positive. Obviously, the leverage is in the right spot, and we have considerable support in terms of the various facilities in place for us to purchase vehicles. And so I feel quite good about where we are in the context of it all. I'd also say that, it's important always to put some historical context to where rates are, much as they will rise from here for certain. I think that level of interest rate still is in an historical context at a very attractive level and makes for the kind of leverage we'll take on in vehicle acquisition to be wholly manageable. And the whole leverage point of the organization is appreciably lower than where it was historically.
And Stephen, finally, I wanted to ask you quickly about another kind of rates, car rental rates, because man, in my traveling plans for coming up over the summer, I've been looking at rates and it's still quite painful. Any relief coming on the horizon?
Well, there's a little bit of supply and demand that's playing out in the rate context. The industry, as a general matter, certainly is experiencing demand that could justify larger fleets than where we are. Obviously, we're going to manage our fleet size to meet demand, but there's a shortage of vehicles in terms of the meaningful uptick that we're seeing, particularly on forward bookings all across the world in the summer. And so it spells good business, but there's an element of supply demand. We're trying to keep, the rate in the proper frame. It's up about 25% year over year, but bear in mind, relative to where the industry was and Hertz was, prior to COVID, the fleet size is down by about 25%. And so some of what you're experiencing is in fact a supply-demand imbalance, but we're looking to continue to make it affordable for all of our customers, particularly as the summer months come.
Well, good luck on this partnership. Hertz CEO Stephen Scherr and Polestar CEO Thomas Ingenlath. Good to see you. We'll talk to you both soon.
Thank you.
Transportation Secretary Buttigieg joins us now. Thank you so much for taking the time here today, Secretary. One of the most pressing matters for the industry, higher fuel prices, which can negatively impact freight companies' expenses and more directly hit earnings for owner-operated truckers and their earnings. So beyond a release of oil reserves, what additional measures is the White House putting on the table to counter these headwinds to the industry earnings?
Well, look, all options are going to remain on the table, and the release of strategic petroleum reserve barrels is obviously a very big one, in addition to actions that have coordinated with partners and allies around the world to try to stabilize that price of oil. Of course, we know that the price of gas and diesel is based on the price of oil, and that's set globally. But steps like this make a difference, even as we're working to take action that for the long run will cushion American drivers, families and professional drivers, from some of those ups and downs of world petroleum markets. We're also insisting that we take a closer look at how these prices flow through in our economy. It seems like when oil prices go up, gas prices go up in a lockstep, but somehow when oil prices resettle back down, the reverse is not true. We need to ask whether, frankly, the industry is doing everything it can to make sure that Americans, drivers, consumers are protected at a time when we need all of us to be doing what we can to help address this issue that affects the whole economy and affects every American.
And to that point, Yahoo Finance spoke to owner-operator trucker Michael Whitaker, and he said that with these diesel costs so high, he says, quote, "I think we're going to have a lot of bankruptcies of individual drivers and trucking companies. Given the amount of goods that travel by road in the US and how dependent we are, what's the administration's plan to really help them? And what message do you have for some of these drivers?"
Well, first of all, that we're doing everything we can to support drivers, both in terms of the bottom line and in terms of working conditions. Look, one thing that affects the bottom line of a lot of drivers, including owner-operators, is the loss of time, and time equals money when they're waiting to pick up a load. Sometimes out of the 11 hours that you're permitted to drive, you've got about 4.5 then alongside that you're not being compensated because your load isn't moving, because you're waiting at a port gate or a warehouse somewhere. And frankly, nobody pays for that except the driver themselves. We've got to look at that, and that's one of the compensation study items that we're taking up right now with the Department of Labor. We're looking at some of the reasons why the typical compensation for a driver is down almost a third in real dollars from what it was in the 1970s. When you have those kinds of trends, then that means there's much less cushion, much less margin to deal with the ups and downs that are happening in the gas and diesel pricing. There have always been those ups and downs, but there has not always been this kind of squeeze on drivers because of those other conditions. We can do something about that. We have as much, or frankly much more, control over that than we do over things like the dynamics of global petroleum markets.
Secretary, as I'm sure you're well aware now, John Oliver teed up a lot of these problems last night on HBO, devoting the majority of his show to the devastating conditions that truck drivers face. He talked about the very things you just talked about, not just what they're paid, but how they're paid. And he also said the problem is a fundamental lack of value placed on their time. They're not getting benefits. They're paid by the mile. How do you, one, convince people to come into a field when there are 11 million open jobs in this country? And how do you convince these major companies to change the conditions and value their time?
Well, that's just the thing. Nobody pays for wasting a truck driver's time except the trucker themselves. Now, I should say, that's not true everywhere. You have some employers that do compensate their drivers for detention time, but a lot of others don't, and when you have these owner-operators, they're really exposed there. Look, I'm glad there is more of a spotlight coming on the important role that drivers play and the way that they're treated. We can take steps on our side, too, like with all this infrastructure money we're rolling out, encouraging states to deploy it in ways that's going to make more parking available. It sounds like a convenience issue, and it is, but it's also a safety issue because of where these drivers are sometimes forced to park before they hit their limits on how long they can safely drive. And it's an economic issue because sometimes they have to end their trip earlier than they otherwise would, or risk not having a place to park when they do hit that limit that's there for safety reasons. So there's a lot of things we can do, and it starts just as a country with valuing these workers because, as the president said, if every truck driver tomorrow morning wasn't driving, everything in this country would grind to a halt. These are the definition of essential workers. We got to back them up, stand with them, make sure they are paid and treated like the very important workers that they are.
And so, Secretary Buttigieg, what level of spending do you believe will be necessary to implement infrastructural changes in order to transition trucking both towards clean energy solutions, also without diminishing transportation times and productivity?
Well, look, we've just put about $50 billion out just in the road funding alone, and quite a bit of that is eligible for things that will improve both throughput and potentially issues like parking. Of course, big picture, we got to have multimodal solutions too. We got to make sure if there's a shortage of trucks, for example, at a port, that we have more on-dock rail to allow containers to get directly from a ship to those railheads, or at least get there with fewer steps in between. We got to make sure the whole system is more resilient, that it's more efficient. We're making up for decades of disinvestment, but thanks to the president's bipartisan infrastructure law, we're now in a position to do so much more than we ever were about it, while also obviously taking a lot of steps on the energy side and across U.S. infrastructure.
And Secretary, we did know that the trucking convoy has left the D.C. area for now, and we know that even though they don't represent the entire industry, there was a lot of negative language. It took a nasty turn. Some truckers threatening to tar and feather Black Lives Matter Plaza in D.C. When you already have so many truck drivers retiring, you mentioned 300,000 a year. What needs to be done in terms of the messaging to make minorities and women who are underrepresented in this industry feel more welcome and really address the lack of diversity in the industry?
Well, first of all, I don't want a handful of people to be viewed as if they somehow speak for an industry, because the good name of the transportation trucking workforce is worth a whole lot more than a few extreme voices. But I do agree that this country and this industry, frankly, needs to do more to include and support women, to include and support drivers and workers of color. And that's one of the things we're working on through this task force. Matter of fact, we set up a whole body of experts that is just going to work on this issue of women in trucking and making sure that they're supported, making sure that they're safe, making sure that the way that training works and the way the parking and arrangements at stops works is going to help them and support them. Same thing for workers of color, because frankly, not only is this a matter of basic fairness and justice and the right thing to do, but just as a matter of economics, this country cannot afford to leave any talent on the table, whether we're talking about truck drivers or the construction workforce that's actually going to be needed to build all of this infrastructure that we're putting out there. We need to make sure that anybody who can contribute is welcomed into this career and supported once they do.
And speaking of the economy, the president touted a lot of numbers about the present economic conditions at your event today, including the recent jobs numbers, the 3.6% unemployment rate. How do you reconcile all those positive numbers with the fact that the president sits at 40%, his lowest to date, 33% on the economy? And what does that mean in terms of accomplishing the objectives you've mentioned to us if that holds through the midterms?
Well, the low unemployment that we're seeing right now and the millions of jobs that have been created under this president are extraordinary. They are of historic proportions, but nobody around here thinks that means the job is done. We know that we see issues around prices. It's why we're fighting inflation with everything we've got, including these supply chain measures. We know that people are still feeling so many effects from the pandemic and a lot of other things before anybody could take a sigh of relief and say everything's going along just fine. Add to that there's always a lot of politics around all this, and it's all the more reason for us to continue focusing on actually delivering results for Americans. I know that's what the president expects of the administration, of cabinet members like me, and we're going to keep pushing and keep getting results.
Secretary Buttigieg, as we get into the summer months, many families and households planning for air travel. It comes at a time, though, at least in this immediate term, that you're seeing either pilots' unions and some pilots go on strike. You're also seeing some of the relationships be tensions between the airline operators and then additionally other staff, whether that be run by the airlines or whether that be other unions that they interface with, especially on the flight attendants front. And so with all of that in mind, at a time where we know it's going to be ramping up, I wonder what type of overlap you're similarly seeing between the Department of Transportation and the Department of Labor on the front of air travel right now.
Well, we're working closely with the U.S. aviation sector to make sure that their recovery from the worst days of the COVID pandemic is complete, and crucially to support those workers who are also essential workers, who can't come to work on Zoom, who have been there throughout and been through extraordinary pressure and extraordinary uncertainty. We need to support them in a number of ways. As with trucking, it means making sure that they are paid and treated well, but also it means making sure that the flying public is supportive. We're pleased to see improvement, but it hasn't gone far enough in terms of ending the disruptive behavior that we've seen in our skies. And that's just one example of a source of pressure and strain on our flying workforce. It's unacceptable. It's got to change, and they need to know that they have the FAA at their back to make sure that anybody working in this field is supported.
And Secretary, I want to ask you about the new fuel industry standards. You said that it'll be a win for every driver in America, but a particularly big win for rural Americans. Until these, though, actually come into force, what kind of relief can rural Americans expect with inflation still so high?
Well, one of the reasons why this is true is that most rural Americans drive longer distances, which means they burn and buy more gas and diesel, which means that they will experience more relief from more efficient vehicles. That's part of what CAFE standards have delivered over the years. And as we get this new round in that's going to take us through model year 26, we could see average or typical efficiency go up to 49 miles a gallon. Compared to today's average efficiency, that could mean the difference, especially if you're driving long distances. As part of your daily routine or your trip to work. That could mean the difference between having to fill up 4 times a month or only having to fill up 3 times a month to cover the same distance. That is dollars and cents cash savings to American families. And again, those who drive the most typically are those who live in rural communities. So, at a time like this, when we're going through so much change and so much innovation in the auto industry, these standards are going to be very important. Obviously, they have an environmental role that's crucial, but also simply important for saving families money.
Joining us now is TaylorMade CEO David Abeles, live at the Masters in Augusta, Georgia. Yahoo Finance's Brad Smith is here as well. Good to see you both. David, I'll start with you here. So you sponsor Tiger. Tiger's playing your irons and woods. What does his return mean to your business?
Well, I'm coming to you live right now from our tour truck right across the street from Augusta National. And I could tell you, being about a couple hundred yards away from the first tee, it's electric. It's absolutely electric. I've been in golf for 25 years. I've never seen the energy around our sport or around this event like I do right now, and all of us do right now with Tiger's return. So it's wonderful to see him on property. He's looking healthy. He's playing well. And we're hopeful that he'll continue his momentum through his recovery here and contend on the weekend. Should be terrific for all golf fans around the world to watch Tiger return to the game.
As you mentioned, David and Brad here, following a car crash that could have taken Tiger Woods' life, one thing to be swinging a golf club, totally elevated consideration to be competing at a professional level. Once again, talk to us about Tiger's bag. Were there any specs, adjustments to Tiger's equipment to get the results that he expects from his swing now in order to make this return to golf possible?
Yeah, fortunately, no. The short answer is no, other than putting a new stealth driver in play, which has been fantastic for him. And he'll talk about that, I'm sure, as well. He's flighting the ball better than he ever has. His speed is up. In fact, we tested him earlier in the week and saw more ball speed from Tiger than we've seen even prior to his accident. But he's got a full bag of TaylorMade products, playing our stealth driver and certainly his custom P7 TW irons, our MG2 TW grind wedges. Got a great bag of TaylorMade equipment and going to perform well for him. We didn't test a whole lot with him over the past couple of months, as you might expect. As he worked into his recovery last month or so, we really started to engage as he can get consistency in his game and we can measure his ball flight characteristics. But nope, he's ready to go, playing the same specifications that he was prior to his accident. And the new driver in play is working out great for him.
Why have you not been able to convince him to swap out a wood in his bag, David, that is 4 generations old?
It's just a matter of time. We haven't had a chance to really test stealth at the pace and rate that we typically do. He's got a couple of them in his backup bag, and there's no doubt in my mind as he continues to progress into the summer months, he'll be in all stealth metal woods, or carbon woods, what we call them now.
Yeah, certainly. I know Brian and I are certainly looking to get our hands on that and try it out for sure. I am still a couple generations past as well here. But when we think about growing the game, what does equipment sales data tell you about demand now versus early in the pandemic when golf was one of the only safe outdoor activities to do, and whether that growth will sustain?
Yeah, we've seen a tremendous run up over the past couple of years. It's been really strong. In fact, we haven't seen growth in our sport at this pace and rate since Tiger actually burst onto the scene in the late 90s, early 2000s, when he was winning his first tranche of major championships. So over the course of the last couple of years, we've seen almost 6 million golfers around the world come into our game on a base of 60, so 10% growth in total participants. But we've also seen participation, which is those that were playing, how many rounds they play, increase by upwards of 20 or 25%. So that has materially affected our business and others in our space. In terms of consumption of golf equipment. We're seeing club memberships at an all-time high. We're seeing tee times and tee sheets booked. We're seeing teaching professionals that have their dockets filled with lessons So fortunately, the golf industry is in a great place today with a lot of momentum that we think will continue to form this new baseline into the future. The data would indicate, to answer your question, that a new baseline of participation has been formed and it's sustainable. So we're excited about the future.
David, I recently bought an entire new set of clubs. I'm not going to tell you the brand because you're not going to be happy with me. I waited 1 month to get all these new clubs, and by my estimation, I paid about 30% more compared to the prior set I had. I imagine this is because of the supply chain shortages. What are you seeing with your ability to get products to consumers, and how much have you had to push through on price increases?
Yeah, fortunately, we're seeing improvement now. It's a little bit hand to mouth over the past couple of years or so, but in large part because we saw 50% capacity requirement increases against the market. So regardless of what category you're in, what industry you're in, to be able to ramp your supply chain by 50% on unit volume from 2019 to 2021 is not the easiest thing to do. Fortunately, we've got a proficiency in our supply chain, so we could probably beat that month lead time that you bought from our competitor. So we're proud of that. But the net effect is we're starting to see the supply chain clean up. Our supplier partners have done a wonderful job investing in capacity, and we're starting to be closer to market than we ever have.
Dave, I got to hustle to my finish here, but there seem to be so many questions about whether a player can choose to play different clubs than who sponsors them or wear different shoes. TaylorMade used to be owned by Adidas. Perhaps you're privy to the typical makeup of partnerships between players and some of these companies, and help us settle the conversation. Does a player need to always play using wearing a sponsor's or wearing a sponsor's gear only during tournament play? Can they wear whatever they want when they're practicing?
Yeah, fortunately, I can only speak on behalf of our players. Our players are endeared to our TaylorMade brand. Many of them have been with us for decades. Dustin Johnson, who's playing this week, Rory McIlroy since 2017, Tiger for the past 5 years. We work so closely with our athletes that they actually love being in our product, love being part of our company, are part of our value chain in terms of our corporate culture. And they play our products at all times because they choose to. So it's a really great thing for us, and I think it's a testament to the great work that our product creation and R&D teams do, and you will see that this week at the Masters.
Well, David, I am very jealous of the weekend you're about to have, but enjoy it, have fun, sell some clubs. David Abeles, TaylorMade CEO, always good to see you. Brad Smith, good to see you as well.
Representative Kevin Brady, Republican from Texas. Representative Brady, good to have you here with us today. We want to play a quick clip from that very hearing, and we'll get your reaction on the other side.
Right. Because oil is a global commodity, Shell does not set or control the price of crude oil. Similarly, Shell does not set or control the price that consumers pay. Indeed, it would be illegal for Shell to do so because nearly all Shell-branded retail stations in the U.S. are owned by independent operators who set their own prices in the marketplace.
And so, Representative Brady, when you hear about some of the pain at the pump that Americans are experiencing right now, what, from your perspective, is the role that several oil and gas companies are playing very squarely in how much those costs are getting passed on to the consumer?
Yeah, so on Washington, I think everyone realized this was just a political theater, a dog and pony show, really for Democrats to try to shift blame away from their policy decisions that have driven those prices at the pump up high and will continue to be higher. Ironically, the same committee just a few weeks ago hauled the same executives in front of them and demanded to know why they weren't committing to reducing their oil and gas production going forward. So, pretty hypocritical to say the least. Look, you got to give Democrats credit. They said during the election or during the campaign, and President Biden as well, that they were going to drive prices up. They're going to try to limit and kill oil and gas jobs and discourage that type of development here in the United States. That's what they've done. The problem is, of course, inflation is at a 40-year high. The price at the pump is really hurting a lot of Americans, especially low income and people of color. So they're in a bind. I think they're looking for a political way out.
Congressman, good to see you. I think you're referencing, Ro Khanna, who did criticize those executives back in October for not reducing their production. But right now we have a problem with the administration would tell you 9,000 open permits that the big oil companies are not drilling on. Why aren't they ramping up production?
Yeah, and that's just economically illiterate. there are 100,000 leases pumping right now. There are leases that aren't either performing, they are locked in, they don't have their permits, or they don't have a way to connect to a pipeline to actually deliver that. Most of those wells will take years to be developed, frankly. And so as we saw at the hearing today, each of those executives talked about massive investment they're making in increasing production. They are getting no leases at all, onshore or offshore, and they are using an incredible amount of money to develop renewable fuels and carbon capture and other clean energy type of technology as well. So, look, Democrats have themselves to blame here, and no one else.
Well, according to the latest NBC poll, when asked who they blame for inflation, 38% said President Biden, 28% said COVID, 23% said corporate price increases, and then a small share cited the Russia-Ukraine invasion. So obviously COVID and Russia invading Ukraine, not things that the US had control over. But what should the Biden administration and even the private sector be doing to try and bring prices down?
Yeah, and as you know, inflation's been raging for a full year now, way before the Russian war on Ukraine. And frankly, inflation is accelerating right now. I think most Americans are bracing for even higher prices. I think that the answer to your question is for the Biden administration, stop making it worse. Right now, they're looking at more spending in a Build Back Better bill, more tax hikes that will end up in higher prices for consumers. And of course, I haven't seen any solution. We're all hoping for one about the worker shortage because that's driving so much of inflation as well. So I think the American public, feels like they're in a recession or a depression already because they've lost so much purchasing power and they don't see any solutions coming forward.
It's really interesting because what we heard from many banks is that some of their consumers hadn't been saving at a rate like this in years. And so now, of course, perhaps tapping into some of that savings because of inflationary measures, also because of some of those costs that are getting passed on to them because wages are higher for some of these worker positions. And then additionally, the supply chain issues that companies are having to navigate. So with all of that in mind, I question, what would you have done differently in order to ensure that Americans wouldn't feel the majority of some of the pain that they are feeling from inflation, and especially at a time where they are seeing exactly what the causes of that inflation were, whether or not it was the pandemic, whether it's an international conflict as well, that's also weighing into that equation?
Yeah, and so one, that's a really fair question. I think the answer is twofold. One, that March $2 trillion COVID stimulus, frankly, drove a lot of demand, stimulus checks, a lot of new federal spending into economy that didn't need it. Also, a lot of the benefit programs, the unemployment benefit program, the Affordable Care Act, healthcare, those subsidies were so lavish, they create a barrier to reconnecting people to work. And I think that we still have some hangover from that even today. And so I think that, one, those were major mistakes at the time. Secondly, I worry the Biden administration wants to repeat those same mistakes in this new $1 to $2 trillion Build Back Better, has some of the same problems within it.
Doesn't sound like a whole lot of excitement for that, even on the left, as if you ask Joe Manchin. But you mentioned the worker shortage here in this country, which is a major issue. But all the while, you've got some former Trump administration officials urging your governor, Greg Abbott, to declare the southern border an invasion. Given the worker shortage and 11 million open jobs, at some point, don't we just need more workers here?
There is no doubt that I think the number one priority beyond this war for this administration needs to be workers, because it's driving so much of the supply chain problems, the inflation problems. Frankly, it's weighing in on growth, certainly along Main Street businesses. We can't find workers to man the production lines, to assemble the products, to deliver those products. And so our frustration, obviously, in Texas is that we are paying such a steep price for these open borders in sex trafficking, criminal gangs, drug trafficking, and fentanyl, which is affecting the whole country. And so facing what could be in a few weeks, another surge created by the Biden administration of illegal migrants into the U.S., certainly states like Texas, we're looking at every option to try to make our communities safe And it's very frustrating. The administration is going full force ahead in ending Title 42, which frankly needs to be extended, and we pay the price for it.
So then in terms of better alternatives to really solve the sort of skills gap that we're seeing in terms of having many more open jobs than we do have people to fill them, what would you propose that perhaps could fix this solution?
Yeah. So first, end all COVID-era emergency programs that are barriers to people returning to work. And we still have some of those in place. Secondly, we ought to have rather than spend, $500 billion on subsidies for $80,000 electric vehicles, instead invest that into the incentives that will get people off the sidelines and back into work. As you know, the Great Resignation really isn't the elderly. In fact, those who are 55 and older are returning to work. It did it pretty quickly. Our challenge is the 25 to about 54, sort of that prime working age that we all depend upon. They are not returning to the workforce. That's where the administration ought to be focused. And you would find, I think, bipartisan support for trying to reconnect those workers to their jobs, because it is a huge crisis right now.
JetBlue making a huge move this week with an offer to buy Spirit Airlines for $3.6 billion, just as the low-cost airline was going to tie the knot with Frontier Airlines. So the question naturally, if JetBlue can close the deal, what's next? The CEO, Robin Hayes, joins us now alongside Yahoo Finance's Brian Sozzi for this conversation. Robin, it's great to have you on the show. Appreciate you taking the time. A lot of people were looking at that Frontier news and saying, low-cost airline, that makes sense. Why is JetBlue a better fit?
Thanks. Great to be on the show, and thanks for the opportunity. No, we're excited. I mean, we've been bringing low fares and great service to customers in the US for 22 years. A Spirit JetBlue tie-up gives us a real opportunity to create a strong national competitor to the large four airlines in the US that we know dominate the landscape, and offer low fares and great service. And I think that is what we are uniquely positioned to do. We truly believe customers should not have to choose between a low fare and a great service. They should have both.
Robin, is the other side of this deal, it would give you some pretty quick access to a whole bunch of Airbus orders by Spirit. By my math, Airbus has 126 orders for Airbus aircraft through 2027.
Yeah, I mean, both Spirit and JetBlue, we have we're both Airbus customers. Airbus has been a great partner for JetBlue for 22 years now. And they're great airplanes in the order book. They're also much more fuel efficient. The airplanes both JetBlue and Spirit have on order are about 20% more fuel efficient. And that's also great given our environmental commitments and our, the important work that we have to do as JetBlue in the industry to lower our carbon emissions.
And Robin, I want to ask about, what the customer might be observing if this merger ends up going through. I mean, JetBlue is offering very low cost fares. I've never found cheaper fares to LAX, but at the same time, you're offering things in your basic blue fare and your blue fare that you have to pay extra for on Frontier or Spirit. So if there is a merger with this low cost carrier, are you planning on going to that type of model as well, or sticking by what you're operating with right now?
No, we're going to stick by JetBlue. It's what we have today. I mean, we have a blue basic fare, which caters for a customer that is very price sensitive. But then we have a blue fare, which has a lot more features in it. And by the way, when you buy our cheapest fare, you still get the most legroom in any US airline. You still get free drinks, free snacks, free TV, and free Wi-Fi. Again, you shouldn't have to choose between a low fare and great service.
Robin, it's Akuffo here. It's great to talk to you today. Obviously, the flip side to this is Frontier, which made that initial bid for Spirit Airlines. They have come out since this news broke saying that essentially this reduces competition because of that alliance you already have in place, the Northeast Alliance with American Airlines. And I wonder if we can pull up specifically what Frontier has said on that front, because they did put out a statement saying that this just doesn't make sense for the consumer. How do you respond to that?
Well, of course, they would say that. I mean, I passionately believe that people love flying JetBlue. I know we're not perfect. We work hard every day to be better. But it's in our DNA, and it's been in our DNA for 22 years. And we couldn't have been successful in New York without it. That low fares and great service, they should go together. And we believe that we can do both, and that customers should not have to choose. And by allowing a JetBlue Spirit merger, we can bring more low fares. The other really important fact on this, the Department of Justice talk a lot about the JetBlue effect, the effect that when JetBlue goes into a new market, we lower fares. What is a fact that when we go into a new market and compete with legacy airlines, fares come down by more than when an ultra low cost carrier does. So not only can we offer low fares to our customers, a bigger JetBlue would have a more national opportunity to bring low fares down across the board. And that's exactly what we're going to do. Look at the fares, what's happened to fares to London Heathrow when we started flying from JFK. Look what's happened on fares between markets like Boston and LaGuardia when we started flying the shuttle. There are endless examples of how JetBlue has disrupted the industry. And by being bigger, we can do even more of that.
Robin, should this deal actually happen, you would have close to, I believe, 50% of the key Fort Lauderdale market. What do you say to regulators as they dig in here and see a stat like that? How do you appease their concerns?
Well, again, when we think about Fort Lauderdale, you have to think about the greater South Florida area. And, we absolutely recognize that there may be one or two areas where, a combination of JetBlue and Spirit have a larger share, and we've always been, very pro-competition. Now, what I would say is that there is access into Fort Lauderdale Airport. Other airlines could add service there at any time, and so there's always opportunities to resolve those one-off issues when you see them. But at a national level, across the country, a bigger JetBlue is profoundly good and better for competition than a Spirit and Frontier combination.
Robin, high fuel price is something that every airline across the board is facing right now. You've already reduced capacity, temporarily suspended some of the flights, or the routes, I should say. Are you considering additional cuts given where oil is today?
Yes, it's a great question. We have reduced our May capacity down by about 8% on what we originally intended, and we're looking very closely at the summer as well. And it's likely that we're going to continue to see capacity reductions through the summer. We said this at a JP Morgan conference we were at back in March, and it's not just higher fuel prices, but it's also to reduce some of the operational stress. Everywhere you look at the moment, there's a lot of stress in the system. There's some staffing issues, and by just bringing capacity down, we can take some pressure off and give us a better chance of operating reliably through the summer.
Robin, JetBlue pays their pilots about 13% more on average than the team over at Spirit. If this deal happens, would you close that gap?
Well, so what happens in any merger is that you'd have to integrate the pilots into a new common system, so it will change. But you can't just look at the pay rates. You have to look at the work rules as well. Actually, if you combine work rules and combine pay rates, that's when you have the most efficiency. What I would say is there is a significant pilot shortage occurring in the US, and the pilot pay rates, the pilot rates that you're seeing at every airline will continue to go up.
JetBlue CEO Robin Hayes, appreciate the time today. Hope to have you back on the show again soon. And our thanks to Brian Sozzi as well.
Don't want to waste any time, and friend of the show, Sam Rowe, the editor of Ticker, .co. Sam, you have a new note, and it's titled "The Most Bullish Story in the Stock Market Right Now." Amazing headline. I would expect nothing less from you, my friend. So what is the most bullish story in the stock market?
Yeah, it's analysts' forecasts for S&P 500 earnings continue to go up. I feel like, this is something that we've actually been talking about, on Yahoo Finance for a couple of weeks now. And, it's funny that that particular part of the story, the earnings expectation, has not been changing. But all the sort of variables and risks, that should be affecting these numbers have been changing. I think the last time we spoke about this, Since the last time we spoke about this, we've had the yield curve inversion. Inflation has only gotten worse. We're hearing about a Federal Reserve that's only, getting even more hawkish with monetary policy. And, of course, we have all the uncertainty related around the war in Ukraine. And so what have analysts have been doing for the last couple of weeks? They're looking at the numbers, they're talking to looking at the reports, industry data, and lo and behold, they're revising their estimates up.
So why, I guess, is the question, Sam? Why are we seeing this optimism here, given all of those headwinds that you're talking about?
Yeah, I think this is something that, even Fed Chair Powell mentioned a couple of weeks ago at his Fed conference. And, one of the things that's happening is there's continues to be tremendous amounts of pent-up demand in the economy. And a lot of it is tied to, persistent supply chain issues. One of the reasons why we continue to have inflation is because of stuff like supply chain delays. And, why do you have supply chain delays? Because corporations, consumers, they still want to buy stuff. There's still a tremendous amount of demand for stuff. So even though there might be, some demand that's lost, at the margins, because of these, backups with backlogs and supply chain delays and stuff, companies are continuing to sell. And so I guess really the only thing that's probably changing is companies, continuing to raise prices in order to sort of preserve their earnings. So yeah, an increasingly challenging economic environment, but you still have a business community and a consumer that has a very strong balance sheet that's still going out and doing a lot of shopping.
Sam, bear with me on this. So just anecdotally, the team took me out for my birthday to a bowling alley. Very, very beautiful. Place was packed. Last weekend, my local Target, packed. I tried to buy some new golf clubs. Everything was sold out. What I ended up getting took me about a month and a half to get. Is it just strange to hear so many folks on Wall Street starting to predict a recession in the country?
Yeah, and you can't blame that. I mean, something to remember about the beginning of a recession is recessions don't start when things are bad. Recessions start when things are good. Remember, it has to be an inflection, at some sort of peak. So, I guess it would make sense that, the recession calls, begin when things are really good. Yeah, and it's a lot of the confluence of all these different signs, including the inverted yield curve that people rely pretty heavily on. But yeah, when you hear from the Federal Reserve and all the various Fed presidents and governors talking about all the different things that they're going to be doing and in order to keep inflation under control, all of it sounds very recessionary. What we were just talking about, all this stuff about pent-up demand and the strong consumer and strong businesses doing all this buying, that's what's keeping inflation up. And the only way the Fed is going to accomplish what it wants in terms of getting inflation down is, if they can figure out how to make the supply chains more robust, that'd be great. But I don't think cutting interest rates will suddenly put more boats, in the Suez Canal or whatever. So they have to slow down the economy. And it's almost, they basically just stopped short of saying that they're going to, try to cause, negative growth in the economy.
And to bring it sort of back around to earnings as well, when we're looking at the Fed's effect and all of that, I mean, the focus is always on forecasts, but it feels like right now, because of what we're talking about, the focus is even more going to be on forecasts. And then I know you're going to continue to watch those earnings projections and whether analysts are revising them up or down. And the other thing, I guess, is that analysts who cover individual companies, they don't tend to look necessarily that far out. They're pretty focused on the next quarter, maybe the full year as well. So when are we going to start to get glimmers here if things are starting to go south?
Yeah, that's a really great question. And, I think people have been asking that exact question for maybe the past year, when inflation starts to creep up and start to eat away at or supposedly was supposed to eat away at profit margins. This past, Q4 earnings season, Q3 earnings season, you go back to Q2 earnings season, that was always the concern. But, companies just came back and said, we're knocking it out of the park because we're just raising prices. But yeah, no, Julie, I think this is, increasingly a concern, especially with, signs like the inverted yield curve that, has historically told us that, a recession may start anywhere from 6 months to 2 years from now. So it might be this earnings season where executives finally say that, demand is actually kind of slowing down. It might be the next earnings season, but it might be that we're finally due for it, especially when you have, the Federal Reserve and policymakers, being so aggressive about trying to, cool the economy off.
Sam Rowe, the editor of ticker.co. Always good to get access to your top market mind. Have a great weekend, bud.